GDP is down by 3%. Per capita, per person, consumption is down by 2%. So the only reason why the economy is still above water, barely, is because of the fact that we got 1.2 million people into this country last year. I tell you that this is not a way to grow an economy. India also has a lot of people. What we need is to see GDP per capita rising. And if you look at overall GDP, is very close to zero. You guys went through the most difficult test since the 1991 recession. 2023 was the most difficult year since 1991. The fact that you are still smiling means that you will smile forever, because the worst is over. And I think that we have to recognize that interest rates are not going to continue to rise. So we are in a per capita recession. The housing market is basically in recessionary territory. The housing market is a buyer's market with no buyers. And we have to recognize that this is going to change. So the fact that people are smiling now, and you did well last year, is amazing, in my opinion, in this environment when interest rates went up by 500 basis points over the course of breakfast. If you told me a year ago, 2 years ago, that the industry will do okay, I will tell you you are crazy. So it tells you how tight this housing market is, but we are now in the 8th or 9th inning of this recession. It's almost over.
So our economy has been very resilient. How far do you think we can stretch this?
Well, it depends on the Bank of Canada. I told you last year, I believe, that the Bank of Canada is starting to overshoot. And they are overshooting by about 50 basis points already. We have a situation in which, if you look at overall GDP growth, is basically zero. Per capita, we are in a recession. Credit growth is basically zero. The last time we've been in zero was in the 1980s. The unemployment rate is starting to rise. Inflation is falling. What are you waiting for, the Bank of Canada? You should be cutting now. You have to realize that the Bank of Canada is a biased bank. You wake them up in the middle of the night and you tell them a recession versus inflation, they will take a recession any day. So a year ago, I told them, stop. You are overshooting already, but they went by another 50 basis points. And now they admit that it was a mistake. And we are paying the price, because you cannot underestimate the price of higher interest rates, especially in this environment, especially now. You see, when you raise interest rates now, it's much more powerful for two reasons. One is that this consumer, your clients, since COVID, was carrying no less than $165 billion of excess savings. Because, during COVID, people got those salaries, but they didn't spend. Their checking account got fatter and fatter. $165 billion of excess savings. So when the Bank of Canada early was raising interest rates, people say, you know what, I don't care. I'm spending this excess savings. I'm going to restaurants. I'm going on vacations because I have this money. This excess savings now is basically zero, which means that the consumer, your clients, they don't have the buffer anymore to protect them for the Bank of Canada, so the Bank of Canada is more powerful. That's one thing. The other, very important, is where inflation is coming from. Early during COVID and after COVID, 90% of the inflation came from outside the country, supply-driven inflation. The Bank of Canada is impotent in his ability to deal with it because, believe me, Putin does not care about the fact that the Bank of Canada is raising interest rates. So the Bank of Canada did not have the power to slow down the economy because inflation was coming from outside. Now, with supply chain back to normal, 90% of inflation is coming from domestically driven sources, sensitive to higher interest rates. So the Bank of Canada is more powerful. So by raising now interest rates, or even last year, you impacted the economy in a much more significant way. You see? So those are two factors that you have to discuss with your clients. Raising interest rates now or keeping them high now is more powerful and damaging the economy more than a year ago because of the increased sensitivity to higher interest rates. That's why I say enough is enough. You are overshooting already.
So let's talk about the inflation rate. The report came out this morning, just before the session started. Prediction was it's going to go up 3.1, but the announcement was 2.8. So what's the analogy with the Bank of Canada? Everybody, such as yourself, who are really have that knowledge of the market, what's the hesitation of the Bank of Canada lowering the rate?
You know, let's discuss inflation because I think it's really important to discuss it with your clients. Let's put it in perspective first. When I say inflation, when you talk to your clients about inflation, what do we have in mind? When you read in the newspaper, inflation, what is it? What is inflation? So first of all, let's remind ourselves that inflation is the rate of change. We all go to the supermarket. We are overwhelmed by how expensive food is, yeah? Yes. Crazy. The Bank of Canada does not care. Not because of the fact that they're not nice guys, they are. But because of the fact, listen to this, communicate. Inflation is the rate of change. It's not the level of prices. So if food prices went up by 10% last year, and today they're rising by 5%, still rising by 5%, that's disinflationary. It's not the level. The level does not enter the calculations. It's the rate of change, and they don't care how high the prices are. That's one thing. So this is something that the Bank of Canada is taking into account. Now, when we say inflation, we mean CPI, yeah, the Consumer Price Index. The target is 2%. Now, we can discuss, and that's another thing to discuss with clients, we can discuss until we are blue in the face. To what extent 2% is the right number? I believe it's not. We'll discuss later why. Never mind, they are not going to change it. You need like 500 PhD dissertations to change their mind. So we are stuck with 2% inflation. The CPI is the target, but of course CPI is very, very sensitive to food prices and energy prices that are jumping. So the Bank of Canada is looking at something called core CPI. CPI minus energy and food because it's less volatile. Fine. So we have two measures to look at. And then a few years ago, they came up with another measure. It's called CPI-X, which is CPI minus other 8 components. And then 2 or 3 years ago, they came up with other one, CPI median, CPI trend, CPI component. They have 6 CPIs measured. Okay, listen to this. It's very important. Why? How do we measure the CPI? They say year over year. And then they say, you know what, year over year is too sensitive. Why don't we do 3 months moving average year over year? And then they say, who cares what happened a year ago? Let's do month over month. Let's do 3 months moving average, 6 months moving average. All of a sudden, you have 6 by 6 metrics. 36 inflation numbers when they release the numbers. 36 numbers, that's an inflationary buffet. Why is it important? Because listen to this, and this is something that you should communicate to your clients. When the Bank of Canada wants to be hawkish and say, we are going to raise interest rates, they can look at those 36 numbers and they can choose high numbers because there is enough there for everybody. If they want to be bearish and say, we are cutting interest rates, they are looking at low numbers. So it depends how they wake up in the morning. What I'm telling you here, and that's the message. The narrative is determining the data and not the other way around. It's not the data that is determining the narrative, it's the narrative that is determining the data. Today we got better than expected numbers. The Bank of Canada is now in the corner. They have to recognize that inflation is falling faster than expected and that they are overshooting. But they always can find numbers that are 2 or 3s in these 36 numbers, in this buffet, to justify no move. And that's more or less where we are. But inflation is moving in the right direction, and there's one more thing that we discussed last year, and it's even more now. Mortgage interest payments. The Bank of Canada is calculating shelter inflation, housing inflation, which is one third of the CPI. Shelter inflation. What is shelter inflation? It's not the price of houses, not there. It's commissions to real estate agents. That's part of the inflation, a small part of it. Rent, makes sense. And then listen to this, mortgage interest payments. that are now rising by 30% a year. Now think about it for a second. That's important. The Bank of Canada is raising interest rates, and discuss it with your clients. The Bank of Canada is raising interest rates. Higher interest rates are adding to mortgage interest payments and therefore adding to inflation. You see how crazy it is? By the very fact of raising interest rates, you are raising inflation, although you are trying to basically fight inflation. Listen to this. If you remove, and by the way, Canada is the only country in the universe that is using mortgage interest payments in their CPI calculations. All the rest, it's not there. What happens if you remove mortgage interest payments from the calculations? After today's number, CPI inflation is 1%. It's undershooting the target. Enough is enough. You are overshooting with interest rates. I believe they should start cutting now, although they will not. Inflation is definitely under control.
So you firmly believe, so for our audience, the weighting average of the housing in Canada is a totally different formula. If the formula removed the interest rate, we are actually already below the 2% target.
Yes, if we follow the US formula, what they use in Germany or France, we will be like 1.5, 1.4. So we are already there. And that's why for the past year, I've been saying enough is enough. When they start raising again in July last year, I said, you're making a mistake. And clearly, if you look at the recessionary conditions in the market, in the housing market, per capita GDP negative, they are clearly overshooting.
So let's talk about the immigration. You confirmed 1.2, 1.3 million people coming to the country. They really sustain the economy. And now there is a notion in the market since December going forward with the reduction of the 5-year mortgage rate of our market overheating. How do you feel about the immigration policies that may put us back in this position that we were a year ago, and the Bank of Canada said, okay, you know what, I'm not dropping the rate because the market is overheated and I continue the same course.
Yes, that's an extremely important question. So we have to distinguish between two things. When we say immigration, what do we have in mind? There are two types of immigrants. One is permanent residents, namely immigrants, and the quota is 550,000. And that's fine. We can discuss whether or not we should change the point system for those 550, which I think we should. For example, one of the reasons why we have shortage of housing is labor. We don't have trades. Good luck trying to find a plumber, yeah? We don't have trades. We don't have construction workers. 300,000 people are going to retire over the next decade. What's coming? Nothing. If you look at the number of new immigrants in construction, 2%. 2% of new immigrants are in construction. I say change the point system to make it 10%. So the immigrants, instead of being the problem, make them the solution. So that's the 550. I have no issue with that in terms of the number, but the point system should be changed. Makes sense. The rest is non-permanent residents, foreign workers, and more so, international students. And we are undercounting the number. The official number is that we have 1.5 international students in this country. The real number is close to 2.5. We are undercounting 1 million. They are there, they are consuming real estate, but we are not counting them for many reasons. We won't get too much into it now because we don't have the time. And I say, those foreign students, 20% of them are in food banks. They cannot find units, they cannot find housing. And I say, if you don't have a quota, and we don't have a quota, the University of Toronto can decide tomorrow that all their students, all of them, are foreign students, paying $40,000 a year as opposed to $7,000 a year. So that, for universities, that has been a gold mine. But if you cannot house them, don't accept them. And I'm not talking about big universities. I'm not even talking about students. 25% of those so-called students, they are not really students. They are coming here to buy citizenship on the cheap. And there are many what I call Mickey Mouse colleges that are not really colleges. the Northern Ontario Advanced Mathematics Academy. Something like that. Doesn't exist. It's a strip mall with one room, and that's a college. $40,000. This is disservice for the country and for the new immigrants. So I was very vocal about if you cannot house them, don't bring them, because they're putting a lot of pressure on the rental market, too much pressure. And also, make sure that they are legitimate. You are taking money from very poor people because they're trying to get into Canada. You're taking advantage of the situation if you are this college. So make sure that it's not there anymore in terms of the number of colleges, and put a quota on the number of new immigrants, foreign students, and that's exactly what the government is doing now. We need to do more. So we have to distinguish between new immigrants, permanent residents, and foreign students. That is a totally different story. And if you put a quota on that, you remove the demand for the rental market, because I can tell you one thing. Just a few months ago, I had an opportunity to meet with the cabinet, the government of Canada. We discussed many things, including housing affordability. And I said, listen, if we don't wake up, if we don't do something about the mismatch between demand and supply, we are going to see pockets of civil unrest. We are going to see anti-immigrant sentiment. And we are going to see renters' strikes. And it's starting to happen. I can see it's written on the wall. It's printed. The trajectory is clear if we don't wake up. Because housing is a very important part of the Canadian economy and people's life. And for some reason, all of a sudden, all political parties, cities, provinces wake up to this reality. Because they know that the next election will be about housing. And we need to, one, reduce demand very quickly, coming from foreign students, because we simply cannot cope. And we have to increase supply in a big way, because we are in a crisis. So you guys will be extremely busy over the next 10 years. You went through the most difficult housing market recession since 1991. And you're doing well. The demand for housing will grow. The supply has to grow. Regardless, you guys will be very busy.
It's a good segue to supply and demand. Initially, everybody talked about the supply. Last year, you met the demand. Talking about the immigration. And obviously bring us to the affordability issue. Do you think ever we can resolve the affordability issue in this country? Or is really we have to accept the reality? Cities, large cities, cosmopolitan cities such as Toronto, Ottawa, perhaps they will not be affordable for everyone.
The short answer is no, I don't think that Toronto or Vancouver will be affordable anytime soon. But I think that we can ease the pain, because the rate at which prices have been rising is crazy. You know, we know what happened during COVID. You all know what happened during COVID. And the decline in prices since then is only a fraction of the increase. So it became extremely unaffordable. You know, interest rates are relatively high, and even when they go down, we can discuss interest rates later, they will not go down to where they were. So clearly, affordability is an issue, will continue to be an issue. I think that the only solution to high price is high price. At one point, people will not be able to afford buying those houses. They will have to compromise. So we're going to see people compromising on smaller units, a rental solution where people will be renting forever, like the way it is in Manhattan, the way it is in Berlin, the way it is in London. A rental solution, and that's why we need purpose-built. We need to build much more. We need to look at factory-made housing, the way it is in Sweden and other places. So there are solutions, but we have to really focus on this crisis in an urgent way, the way we dealt with the virus.
So with the affordability crisis, do you foresee, and also the implementation of the virtual work, hybrid work model, do you foresee the growth more in the suburbs areas such as Simcoe County, Peterborough, and how do you tie that with the employment and how of the workforces and the businesses?
Yes, that's the tricky part. And I think, yes, I think that you will see more and more activity in the suburbs and the jobs will be going there. Core cities became extremely unaffordable. And if you look at the office segment of the market, you can see that core, downtown, not doing very well. But if you look at suburbs, doing extremely well. Same goes for retail. So clearly, suburbs are actually taking advantage of the situation. Things have changed. So when you discuss the situation with clients, especially when it comes to location, we always have to ask ourselves, to what extent COVID was an event or a condition? And it was clearly a condition when it comes to real estate and when it comes to the economy. Many things change in a very dramatic way. So that's the way to frame your conversation with clients about those significant changes. The cities are not exactly the way they used to. The suburbs are more powerful, and you will see more and more jobs going there. No question in my mind about that.
So government, we talk about election. So obviously, we all pray that the election be this year so we can get Mr. Trudeau out of the office. So government policies, for the last 5, 10 years, they made an announcement. Mr. Trudeau can just say, building here, building there. Do you think ever these government policies, what is lacking there? Is it just a political announcement? What is really need to be done so we can create a consistency and affordability across the country?
I think that there are so many things, and we cannot discuss all of them. A lot of things are, for many, many years, we were using demand tools to fight what is a supply issue. Only in the last 2 or 3 years, we have seen government starting to realize that it's about supply. So that's a good thing. Because until now, we were basically trying to encourage demand without supply. So there was too much demand, no supply, and that's why prices went up and up. Now they're starting to realize we need to do something else. And part of it is a rental solution. I believe, as I told you in the past, that we have to create a situation in which if you are 35 years old, you are married, you have 2 kids, and you are renting, nothing is wrong with you. We have to create this kind of mentality in the country. And I can tell you that if you look at the other places in the world, that's exactly the way it is. So it's doable. For this, you need purpose-built rental. You need companies, because the next wave of renters will be families with kids. They don't want to deal with a landlord in a condo. They want to deal with a company, and they need stability for maybe the rest of their lives. That's the way we have to look at the situation. And for this, you need to provide incentives to developers to go with purpose-built apartment buildings as opposed to a condo. So I was very vocal about the HST. They removed the HST. I want to do other things to allow developers to choose purpose-built and make it economical for them. And we are going this direction. I think that we have to focus on the missing middle. We have so many buildings in this city, in this country, that the infrastructure exists, but it's one floor, like the post office or something. You can have the post office and then 20 floors above it. So we are wasting a lot of space that is available. The land is there, the infrastructure is there, just build. Converting offices to units for residential sounds good, doesn't work. They are doing it a little bit in Calgary, but it's really, the economics of it is not really working, so that's not a solution. But there are many other things that we can do, including getting more people into construction in terms of labor or trades. You look at Nova Scotia, if you are under 30, you can get tax breaks, significant tax break if you go to construction. Something like that. Use the tax system to encourage people to go to construction, break the negative stigma, and definitely get new immigrants in this trade as well. So there are a lot of things that can be done. Anything to do with supply, it takes time. That's why we have to deal with the demand first in terms of the non-permanent residents. And also we need forecast. One of the housing crisis is a planning crisis. And this is important to understand. It takes municipalities about a decade to get the land, to prepare it, to auction it, to develop it. It takes a decade. So you need to know what's your quota. So in 2013, 10 years ago, the government went to municipalities and said, population growth will be X. And that's your quota, start preparing. In 2023, population was X plus 1.5 million. They undercounted by 1.5. And 90% of this 1.5 were non-permanent residents. So you cannot blame municipalities for not being ready for something that was not in the plan. So it's a planning crisis, not just a housing crisis. And that's why we need more accurate planning that is related to government policies. The government cannot wake up one morning and say, we are accepting 1 million people more. You don't have the infrastructure for that because you didn't plan. That was not in the plan. That's part of the problem.
So, a couple more questions before we go to the audience. So, U.S. election this year. We got Mr. Trump. I guess it's going to be maybe another be president. U.S. economy is growing fast, and it's how do you see that Bank of Canada, back to the discussion about the interest rate, currencies differences? Do you think the U.S. growth of the economy and the fast pace will force the Bank of Canada to make monetary changes faster?
Yeah, that's a very good question with major implications for your business because it will impact the Bank of Canada. So let's discuss it for a second. Why the US is doing so well? The US is like an emerging market. It's like a tiger. 4% GDP growth. We are zero if we are lucky. Why? And by the way, Germany is almost zero. Even China is down. The US is the only game in town. Why? For a few reasons. One is their sensitivity to higher interest rates. It's much lower than in Canada for two reasons. One is their mortgages, 30 years. Our mortgages, 5 years. So when we raise interest rates, immediately 20% of people get it. They wake me up when it's relevant. So it takes time for them to feel the pain. That's one thing. The other is that you have to go back to 2008. The mother of all recessions in the US led to the mother of all deleveraging. Their debt to income ratio went down dramatically. Ours, 2008 was not our recession. We were basically second-hand smokers back then. So we had a situation in which our debt went up. When you have more debt, you are more sensitive to higher interest rates. How sensitive? 1% increase by the Bank of Canada is equivalent to 2% increase by the Fed. And that's why the Fed has to go higher than the Bank of Canada to be in the same place. That's one thing. Then, of course, you have productivity. Productivity in the US is rising nicely. In Canada, it's negative. So that's another factor why they are doing better. Another factor is fiscal policy. If you think that Trudeau is spending like there's no tomorrow, try Biden. The budget deficit is 6% of GDP and rising. That's another factor. So all those factors suggest that the US is doing well. Now, there are early signs that the US economy is slowing down as well, from 4% to about 2%, but still higher than Canada because of all those reasons. Now, can the Bank of Canada divorce itself from the Fed? Inflation in Canada is behaving. We are in a per capita recession. What if the Fed does not cut? Can the Bank of Canada cut? Now, usually the spread between the Fed and the Bank of Canada is 100 basis points. Namely, the Fed is higher by 100 basis points. We are now at 25 basis points spread, which means that the Bank of Canada has leeway of about 50, even 75 basis points of cutting before we go to something that is abnormal. So the fact that the spread is very narrow allows the Bank of Canada to cut before the Fed and divorce itself from the Fed. It happened before, can happen. I think it will happen.
So my last question, and probably it's a very loaded question. So Canadian economy has shifted for the last 10 years from an energy sector economy to really relying so much on housing and ancillary services around the housing, mortgage finance, insurance, and everything. So I would love to hear your view. Is this economy relying almost on 30-40% of it on housing and immigration is sustainable for future growth? And how do you see the other industry will evolve in the next probably perhaps 5 years?
Well, the way I see it is the following. Housing is a human right. People need housing. So I don't buy the notion that housing is, too big in terms of real estate, in terms of the share in GDP. However, clearly activity was crazy during COVID when interest rates are zero. So what we did, really, if you think about it for a second, during COVID, young people, renters, that's the people who lost their job. Home buyers were zooming. So, and interest rates were basically zero. So to understand the housing market during COVID is to say that home buyers got the benefit of a recession vis-a-vis an extremely low interest rates without the cost of a recession vis-a-vis a broadly based increase in the unemployment rate. That's the way to explain COVID or housing during COVID to clients, which means that when there is a sense of urgency to get into the market, and there was, as you all know, sense of urgency, the huge increase in 2021 in your business, people were borrowing activity from the future. They were front-loading activity because it was a golden opportunity to get into the market. Interest rates were so zero, and you still get your salary. And that's why it was crazy. So this is not a crash. This is not a correction. This is reallocation of activity over time. And that's why I think that the share of real estate that we have seen in 21, 22 is abnormal. It's not going to continue, and that's a good thing.
I guess we open it to the audience. Thank you very much for answering all the questions. Perhaps if we can get some mics, guys, Shant and some of maybe the leader that can assist in terms of, we have mic here, I think, on Deborah's table. Thanks, Laura. Go ahead, Deborah.
Where do you think interest rates should be right now? Where do you think they'll end up in the year?
Yes, that's the question. So first of all, I think that interest rates should be 50 basis points lower than they are now. I think that the Bank of Canada is overshooting by 50 basis points, and I think that the Bank of Canada deep inside already knows that. Where are they going in real life? First of all, let's establish that the Bank of Canada is done. They are not raising interest rates anymore. That's done, that's a given. Unless something crazy happens, they are not really looking at raising interest rates. So the only question is, when? There was a debate in the market whether or not it will be July or June. After today's inflation number, more and more people, and I believe that that's the case, June. So let's assume to be reasonable, June or July, more likely June, they will start cutting interest rates. By how much? They probably will cut by 75, 100 basis points over the course of 2024, namely in the second half of 2024, and then will continue in 2025. How low can they go? I think a reasonable number, we are at 5 now. We stay at 5 until June, July. We cut by mid-2025, late 2025, let's say 275, 3%. Now, we started at 175. We went to 5, and we end up at 275, 3. And that's important to understand and explain why. 175 was history, was old. Why? Because it reflected a different era. When you discuss a condition versus an event, the condition story enters here. We used to have globalization that was disinflationary. Now we have deglobalization that is actually inflationary. We used to have just-in-time inventories that were disinflationary. Now we have just-in-case inventories that are inflationary. We used to have a labor market that was giving. Now bargaining power is back. That's inflationary. And all those green initiatives, they are inflationary. So there are 4 inflationary forces cooking. The target is 2%. If you have more inflation coming, and the target is 2%, clearly interest rates have to be higher than they were before. And let me remind you that your industry can do extremely well with a 3% overnight rate. In fact, this is a healthier solution and situation. I don't think that 175 overnight rate is healthy for anybody, because if there was something that was mispriced over the past 20 years, it was cash. So 3% to 75 overnight rate, Bank of Canada rate, to me, is actually a very good rate, and you can do extremely good business in this environment given the demand and the lack of supply.
Thank you. Next question.
Thank you. These days, some developers stop buying land and leave this market because of the hard cost and interest rate. What do you think happened in reconstruction after 5 years?
Sorry, the question is about reconstruct?
Yeah, the question is the developer, some are basically leaving, investing and building. So because of the higher cost of the construction.
Yeah, I think that the story of the housing market today is a story of two markets, low-rise and high-rise. The low-rise is already in a recovery mode. There is no inventories, prices are starting to rise, and if you look at the demand, it's actually very interesting. Below $2 million, there is demand, as you know. Between 2 and 5, the market is not great. 5 and over, the market is very strong. So it's really asymmetrical. But that's the low-rise segment of the market where inventories are very low. The high-rise segment, the condo space, that's where we see some difficulties because pre-sale activity, pre-construction activity is basically dead. Dead. People are not unable to sell on paper. So, but we still have inventories of things started 2 years ago to complete. So inventories are still rising while demand, especially from investors that are 50-60% of the market, is down because about 65% of investors are in negative cash flow at this point. So they are not in the market or even they are selling. So I see the condo market basically clearing over the next 6 to 8 months with some softness in prices and activity. And therefore I say, and you can tell it to your clients, I think the best time to buy a condo is basically now, over the next 6 months. Because guess what? Those pre-sales activity that are now zero, we will need them 2 years from now, 3 years from now, when demand is back, when interest rates are down, the supply will not be there. You don't have to be an economist to predict where prices will be. So I think that the condo space will clear. You can sell for the right price of your current inventories, and that's exactly what's happening. Developers are becoming more and more realistic in terms of prices. This means that it's actually not a bad time to buy a condo over the next 6 months, because 2 years from now, I believe that prices will be higher.
Thank you.
I think we have one more question. We have to wrap it up.
Yeah, one more question and we have to wrap it up.
You made a comment earlier about developers being more incentivized to build more apartment-style buildings. I just want to know what type of incentives would that be? Maybe because they could build a small-rise condo complex, 16 units, get $600,000 a unit if they sell it, or they can build it as an apartment building, get half of that. So what would be the incentive for a developer to actually build more apartment style?
Yeah, at the current environment, you don't have really an incentive. And if you compare condo versus purpose-built, condo wins unless you own the land for the purpose-built, and that's a totally different story. Remember that also people that are investing in purpose-builts are not regular investors. They are, deep pockets, pension funds. So their way of looking at the investment story is very different because it's long-term. But I think you need more incentives. For example, HST was the move in the right direction. It's basically saved $55,000 in terms of cost per unit. So we have seen some developers already doing purpose-built just because of that. But we need more. There is something called in the US 1013 exchange, which means that if you invest in commercial real estate, including multi-residentials, purpose-built, and you sell, and you invest the profit in something else in that commercial real estate, you don't pay taxes. In Canada, you pay. So if you basically treat capital gain differently in Canada, that will basically attract many people into this field. You can give discount on the land. You can do many other things to basically cut the cost for purpose-built, and I think that's the way the government is going at this point.
Thank you very much, Benjamin. Ladies and gentlemen.